Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday the 17th of February 2016 and we're providing the first of 3 videos as to our predictions for gold and silver for this year. We had proposed to produce just 2 videos. However, their length would have been too great, and so we have produced 3. Today's covering gold, Friday's covering silver, and Sunday's covering our actual pricing, supply and demand forecasts. So in order for our subscribers, viewers and listeners to understand how we come to our conclusions, we have highlighted those factors we take into account. Today we are looking at what actually influences the price of gold in today's economy. There are 11 main factors. 1. The value of the US dollar. The US dollar is still the world's dominant reserve currency, making it one of the main currencies that different countries hold for international trade. The price of gold and the strength of the dollar have a pretty clear inverse relationship. When the dollar is strong, gold tends to become weaker, and vice versa. Whilst this is not always the case, it does apply in the majority of instances. We have seen, over the past 12 months, the dollar index gyrate between 92 and 100, most of the time being spent in the upper 90s. 2. Interest rates. Gold does not pay interest like treasury bonds or savings investment accounts, or dividends like shares. But current gold prices often reflect increases and declines in interest rates. As interest rates rise, gold prices may soften as people sell gold to free up funds for other investment opportunities. As interest rates decrease, the gold price may increase again because there is a lower opportunity cost to holding gold when compared to other investments. Low interest rates tend to equate with greater attraction to gold. 3. Inflation. A common reason cited for holding gold is as a hedge against inflation and currency devaluation. Currency values fluctuate, but gold values, in terms of what an ounce of gold can buy, has over the long term maintained its purchasing power. Gold is seen as an attractive, low-risk, solid investment in the midst of floundering currencies. Investors may feel encouraged to buy gold when they believe the value of their paper money will decline. 4. Global crisis, safe haven investment. Because gold prices tend to rise when people lack confidence in governments or financial markets, it is often called a crisis commodity. World events have an impact on the price of gold because gold is viewed as a source of safety amid economic or geopolitical turmoil. For example, the price of gold spiked after the Russians moved into the Ukraine, as people became uncertain about geopolitical stability in the region. It also rose when there was a serious possibility of Greece's exit from the Eurozone. More lately, it has risen since the beginning of this year as a result of major stock market falls around the world. In a nutshell, political and economic chaos equates to more interest in gold as a safe haven. Despite a weak first half to 2015, physical coin and bar demand by private investors actually rose in 2015 compared with 2014 from 1,000 tons to 1,011 tons. 5. Quantitative easing. Quantitative easing, or QE, at its most simple, refers to a central bank strategy of buying securities in order to increase the money supply. By flooding financial institutions with money, a central bank, like the Federal Reserve, hopes to encourage banks to loan more money and increase its supply and engineer economic recovery. Other central banks that have employed this strategy include the Bank of England, the Bank of Japan, the European Central Bank, as we have remarked upon in previous videos. A larger money supply pushes interest rates down, which could encourage investors to buy gold because of the lower opportunity cost. When overdone, this tactic can trigger inflation and some fear hyperinflation, another signal of a rising price of gold. The Fed actually announced that they had stopped QE on October the 29th, 2014, and this put further downward pressure on gold prices as it was believed that the next move was a rise in interest rates. 6. Central bank instability. Most countries have central banks, and in the US it's the Federal Reserve. In Europe, the European Central Bank. You also have the Bank of Japan, the Swiss National Bank, the People's Bank of China, etc., etc. Bank failures and bail-ins and irregular economic policies make gold buying seem like a safe haven investment. Once again, people flock to gold when the current paper money system experiences uncertainty. Some investors prefer the physical and tangible security of holding gold when central banks are going through deficits as a protection of wealth. This increase in demand drives up the value and price of gold even further. 7. Government reserves and holdings. Central banks, like the US Federal Reserve, hold both gold and paper currencies in and as reserves. In fact, the United States and several European countries hold the bulk of their reserves in gold, and they have been buying more gold for these reserves recently. When these central banks start to buy gold in greater quantities than they sell, it drives gold prices up. This is because the supply of currency increases and available gold becomes scarcer. The World Gold Council recently announced that central banks purchased some extra 33 tons of gold in the fourth quarter of last year, compared to the same period the previous year. 8. Jewellery and Industry. Gold is not just valuable as a hedge and a safe haven investment. Gold is also used in jewellery and industry. Around 60% of gold demand is for jewellery. In fact, China and India accounted for approximately 50% of total gold demand last year. In some parts of India, gold is still regarded as a type of currency, a display of wealth, an important gift, and a hedge against bad times. In China, gold is a symbol of opulence, and a booming Chinese economy has meant that people have had more money to spend on it. And in fact, this has been encouraged by the Chinese government. Total jewellery demand for 2015 was 2,455 tonnes, and demand for industrial uses stood at 330 tonnes, both slightly down on the previous year. 9. Gold production. It is estimated that above-ground stocks of gold stand at 183,600 tonnes. Mine supply for 2015 stood at 3,165 tonnes, marginally down on 2014. Even though new production might seem modest compared to the total supply, production costs can influence the price of gold throughout the world. When production costs rise, miners attempt to sell gold at higher prices to preserve and protect profits. We have also seen of late, when shortages have occurred, premiums on gold coins and bars rise quite considerably. 10. Speculation. We have often heard that investors purchase gold as a hedge, and others claim it is purchased as a speculative investment. Let's look at a brief definition of each of these. The dictionary meaning of hedge is to protect against risks from price fluctuations. The dictionary meaning of speculate is to assume a business risk in hope of gain, especially to buy or sell in expectation of profiting from market fluctuations. Well, without going into the advantages and disadvantages or the moralities of each, it is a well-known fact that the amount of paper gold traded vastly exceeds the amount of physical gold that exists. According to Nick Laird of Sharelings, the notional value of paper gold traded in a day at current prices is around $125 billion, or 3,248 tons, more than the annual physical supply. Clearly, this has a bearing on and impacts the underlying gold price. 11. Supply versus demand. Total demand in 2015 weighed in at 4,212 tons, compared with 4,226 tons the previous year, according to the World Gold Council. However, gold demand growth rose towards the end of the year. Fourth quarter demand was in fact 1,117 tons, up 4% from the same period a year earlier. Total gold supply fell 4% to 4,258 tons, but still marginally outstripped demand for the year. Gold has been mined and coveted for at least 5,000 years, and this precious metal is likely to remain precious even if the price fluctuates often. If you plan to buy gold, you need to understand that the price is impacted by production costs, money supply, comfort or discomfort with financial or geopolitical stability, the demand generated by jewellery and industry, and actions taken by central banks. In other words, gold is a finite resource, and when global economic conditions make gold more attractive, gold demand increases, making the price of gold rise. But the actual value of gold remains fairly stable in the long run. That means it maintains purchasing power, and the current price could simply reflect temporary uncertainty or simple currency fluctuations. So these are the main factors we consider when looking at our forecasts for the gold price in years to come. Of course, we go into much more depth and analysis with each of these factors, but they briefly highlight some of the main considerations we contend with. In addition, we look at other commodities and price comparisons, and the political agendas of future prime ministers, presidents, and kings. Please tune in to our next video of this series, which will be released on Friday. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at www.illuminatisilver.com and look at our Facebook page, which is updated daily at www.facebook.com/Illuminati Silver. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.